Why does index methodology matter when evaluating the next generation of factor solutions? Hello, I'm Jenny Ellis from Asset TV. Joining me today to discuss the new S&P 500 factor indices that track market leaders, quality companies at the intersection of growth and value, and the companies from the S&P 500 returning the most value to shareholders are Liz Bebb of S&P Dow Jones Indices and Sturmius Schneider of Xtrackers. So Liz, Sturmius, welcome. So Liz, I'm going to come to you first and let's zero in about the indices we'll be talking about today. S&P Dow Jones Indices launched the S&P 500 market leaders, the S&P 500 GARP 100 and the S&P 500 resilient shareholder yield indices at the end of 2024. So how are these indices designed and what data sets are powering them and why are they so unique?
I think they're unique in many ways. When you look at the traditional factor indices, for example, we know that they're usually defined by several metrics which relate to certain characteristics with indices which drive the performance, and the performance can be different in different market environments. When you look at the S&P 500 indices that we've put in the next generation, let's take the S&P 500 market leaders, for example. That particular index uses a syntax data set. This data set is a very granular version of market share scores, so we can actually calculate market share scores and define leaders by their market shares. When we add in the free cash flow margins, which look at the profitability of those companies, the returns on invested capital metrics that also look at sort of how well the companies generate future returns or generate current returns, we can see that these market leaders indices are quite, the metrics actually tilt towards quality. So it's very much sort of a quality base. And then on top of that, we use the float market caps to do the weighting, tilting back to that leader ideology. Sort of this also gives some diversification within the index because we use a stock cap as well of 4.5% per stock, which reduces the sort of information technology weights, etc. So they're quite well diversified as well. And if we look at the other versions, so the S&P 500 GARP 100, for example, that version uses a quality value metric and the growth metrics to sort of derive the actual selection of the constituents. And on top of that, it uses a float market cap multiplied by the growth score. So again, you're tilting back to that growth metric. So the S&P 500 GARP 100 looks at a quality, value and growth metric in its construction, which creates a constituent selection that can be very different to the other indices. And it can be diversified versus the S&P 500, the universe that it comes from. Additionally to that, it uses a growth metric when it's multiplied in the weighting via its float market cap, and that tilts back towards growth as well. So we see that coming through in the index again. And if we look at the S&P 500 resilient shareholder yield, we see a similar thing. Resilient shareholder yield is looking at sort of the dividend income of those companies. It's looking at the share repurchases of those companies, and it's also looking at the share repurchases. And those three metrics together are driving a set of performance within that index through the constituent selection and the characteristics that it produces. Alongside that, we actually use the shareholder yield score to actually weight the index as well against FMC and have that capping again. So again, you see this methodology being quite unique in these aspects.
And Sturmius, from your perspective, what was interesting about these indices and why?
So what really stood out for me about these indices is how they capture the hybrid factor signal. So essentially, they try to codify what active investors have intuitively pursued for many years. Traditional factor indices usually only cover a single dimension for factors, value or growth. And by blending multiple factors, there can be a very transparent and structural approach to a factor blending. Take the GARP index, for example. So the GARP index seeks to address a key shortcoming of traditional growth exposure, which recently is trading at PE multiples north of 30. These are levels we haven't seen since the dot-com bubble. And by integrating quality and also valuation characteristics into a growth index, this can actually bring down or address this key shortcoming. What's really compelling about these indices is also the methodology. So the methodology is very transparent, and that clarity is a key for investors. Investors actually get and can understand what they are getting. A diversified, rules-based approach, which is actually addressing what they are looking for in terms of risk and returns.
And coming back to you, Liz, can you expand on these indices performances? How have different factors played out in different environments historically?
Thank you. I think when you think about traditional factor indices, in different market environments, they perform in different ways. So, for example, your value factor is going to perform well in sort of cyclically recovering markets. You're going to see perhaps good momentum in trending markets, whether they're trending up or down. And you're also going to see sort of a good performance in quality in most markets. It does very well in the majority of markets. And when you look at the next generation of indices or the new generation indices, they're very similar. We did some analysis research in-house, and what we did was we took each of the sort of the macro backdrop and we looked at it in different ways. So we categorized markets into high and low growth and high and low inflation. So we ended up with 4 different categories. And when we looked at these particular new generation indices, what we saw was they performed very differently in different market environments. So for example, when we thought about the resilient shareholder yields, the S&P 500 resilient shareholder yield, what we saw was this performs really well in falling growth, rising inflation markets. The S&P 500 GARP 100 does really well in rising growth and falling inflation markets. But the market leaders actually performs quite strongly across all markets. And that's because of various factors, both the methodology construction that we've talked about before, but also because of the fact that it's quality bias and those characteristics are shown through. So quality tends to do well in most markets.
And Sturmius, how are you seeing market participants using factor strategies in their portfolios, and what's driving decision making?
So we're seeing 2 types of factor investors. On the one hand, there are factor investors that use factor products strategically. So they believe in the long-term factor premium and allocate to the same factor over a long time. On the other hand, there are factor investors that use factor products or factor indices more tactically. So they would, based on, for example, the macroeconomic environment indicators, rotate from one factor to another. And what's very interesting about the S&P Dow Jones indices that we're talking about is that they address actually both types of factor investors. So on the one hand, they show in simulations over very long periods, they show improved risk-adjusted performance. And on the other hand, they have a clear factor tilt. So GARP aligns with growth, market leaders with quality, and resilient shareholder yield with value and minimum volatility. So well-known and traditional factor exposures. Unlike sector investing, factor investing is not a zero-sum game. So blending different factors can actually rather enhance than dilute portfolio outcomes. And they feel particularly relevant in today's market environments. So equity valuations are skyrocketing, concentration is increasing, and dividend yields, for example, of the S&P 500, they have compressed towards 1%. So difficult market environment. And identifying companies that may be the market leaders of the future, or identifying companies that are growth companies that have growth potential, but still at reasonable valuations, or companies that offer shareholder returns, total shareholder returns, is actually an interesting way to navigate today's markets. This allows investors to seek for different performance and return drivers in today's environment.
That's really interesting, and it shines a light on why index methodology is so important, especially when looking at this new generation of factor indices. So Liz and Sturmius, thank you for joining us. Well, to learn more about S&P DJI's factor indices and to explore the latest factor research and data, visit the link below.